Hey everybody, good to be here today. Time for long options. Today I want to talk about leaps, pros and cons of leaps, what leaps are, how to actually execute those trades, and what we're talking about, why people do them, and why maybe you would consider them for a portfolio. It's always, it's not clear cut on for any trade we do. There's definitely pros and cons, but I'm glad to be here. I'm also glad to be joined by Mr. Ben Watson, who's helping me out in the chat. Ben has uh, a lot of experience here. And for those of you who aren't familiar, Ben is the primary face, I would say, so to speak, of on Schwab's live workshops as we go around the country. And there's a reason for that. He's very good at what he does, very knowledgeable, and we're happy to help him. Happy to have him in the chat. As you have questions, feel free to type those in between Ben and myself. We'll do our best to help you out. You can also follow us on X at Brentmore CS, at Ben Watson CS. Now let's hit up some disclosures before we get to the main stuff here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. The paper money application is for educational purposes only. And so, in other words, don't. It's not a recommendation, and it's not exactly the live platform, but it is a good trading. It's a good education tool there for you. All investing involves risk, including loss of principal. There's no guarantee of a stop loss that it's going to execute at or near the stop price. Past performance of any security or strategy does not guarantee future results or success, and paper money application will not assign short options early. There we go. Let's head on over to the Thinkorswim platform. As I mentioned, we're going to talk about leaps today. I want to start off with some basics on leaps. I want to then look at some example trades on those. And often with leaps, at least for me, more often than not, I'm in a long call leap mentality. You can do them on puts too. You can do a long put leap. Now, can you go short? You can, but that's not the subject of this class. It's probably a less common trade. So we're sticking with long today. Long calls, long leaps. Leaps, for those of you who aren't aware, are just really long-term options. Okay, if you look at an option trade, if you look at option possibilities, let me just we'll bring up Microsoft MSFT here. And you'll see when you go there, there's a lot of different expiration dates. And, some are near, some are far. Those that are a year or more are what we're going to call LEAP. It stands for long-term equity anticipation security. So technically LEAPS isn't plural. But there is, you can go out 900 that's a long ways, right? December of 2027. I know we're in 2025 right now, but that's out to December. So that's 2.5 years away. So you can do that. So why would we do that? Well, generally, we're probably going to do that on a longer term trade. But in terms of the mechanics of leaps, it's the same, right? The whole 100 multiplier, you see that 100 there on your screen? That's the 100 multiplier. It doesn't matter that it's out that far. That still works the same. It's still a leap call is still the right to buy 100 shares of stock at, if that's your multiplier 100, which it usually is, at on or before the expiration date. A leaps put is still right to sell 100 shares of stock on or before that expiration date. That still works the same. But of course, practically, there is a difference here on what we're doing. In fact, if I go out here and let's just we'll go out a couple years, we'll go to June of 2027. So basically 2 years out. Look at what we got. We'll go at the money, Microsoft. Now, Microsoft is a more expensive stock. Let me go to a less expensive stock here, just to give you an example. Here's Bank of America, $44 stock. Let's go out. We'll go out again to June. How much is an at the money contract going to cost? Around 44. Well, we don't have exactly. We'll do a $45 strike. $700. Well, what if instead I go out a month? How much is that 45 going to cost? About $74. So like 10 times as much. Leaps are more expensive, okay? Leaps are more expensive. Probability trader, I'm going to get to that. I'm going to talk about time frames here on this. Ben can weigh in if he wants on that, but we'll talk about time frames on these. But the first thing I want you to know is when you buy more time, you pay for it. There's more extrinsic value in these options when you do leaps. And so that's the first thing. Number two, because they're more costly and there's more extrinsic value, that extrinsic value decays away over time. That's true for any option. Any long option, we have theta working against us. Now, the rate of time decay on an option is, an option that expires in 750 days isn't that fast, right? You can pull up a theta column. Let me pull up a theta column here. Here's theta. And it's not, it says zero, it's not zero. It's rounding to zero there. So, but it's a small number. Whereas if I go shorter term, then you can see we're actually showing numbers there because the theta, the rate of time decay, that ice cube, so to speak, for those of you who are familiar with the ice cube analogy of option prices melting, just it melts quicker for those shorter term option. That's something. Here's another thing. When you look at deltas, let me go out of the money here just a little bit. Let me go to, say, a 40 strike on this. The 40 strike has a 90 delta for the option that expires in a month. Let's go to that 40 strike out here. 40 strike, what's my delta? 67. Your deltas are going to be the out of the money contracts or in the money contracts. Your deltas are going to be closer to 50 than they would be as you get closer to expiration. The other way to say that is as options get closer to expiration, those in the money deltas tend to get closer to 1. The out of the money deltas get closer to 0 as you get closer to expiration. If we're out a long ways, we're probably going to be closer to that 0.5 delta there on that. Okay? So that, there's some good questions in this chat here. And Rice Bird, that's a good question. We're going to talk about that just a little bit here. Just hold on one sec. We're going to get there. Okay? So longer term expirations. Think about trading short term versus long term. Some of you are familiar with some of the differences there. Often when we're doing these short-term trades, go to, one of Ben's classes that Ben teaches. When he's doing short-term trades, he's going to be focusing more on the technical analysis than the fundamental analysis. Okay. Now, technically, there's different approaches to trading. Schwab doesn't recommend technical analysis as a sole means of investment research. But I think the truth is most longer term traders, tend to gravitate more, longer term investors will say, tend to gravitate more towards fundamental analysis, and shorter term traders tend to gravitate more towards technical analysis. We can do both, but when we're talking about longer term trades here, then when we're talking about longer term trades, there's probably going to be some fundamental analysis that creeps in the equation there on that. So that's another thing. And these are longer term trades. We're going to talk about that in a sec here, but we're probably going to use looser stops, right? If we're just trading a stock, let's say we were trading Bank of America stock and we're doing a short term, maybe a little swing trade, we probably put a stop pretty tight. A trade though that I'm planning on holding on for a year maybe, I'm probably not going to put a stop quite as tight. Okay, so, as tight. So let's think about trades. Okay, we actually have a trade in that we put in last week's managing an options portfolio session. This is just a long call trend trade. Now, I just use the term trend trade. I want to give you a distinction here that I think is going to be important for leaps. Sometimes we do swing trades, okay? Swing trades often what we'll do is we'll try and get in at up right before we think a stock's going to move up. Maybe right here we think the stock's going to jump up or something, and it goes up, and well, great, it did what we wanted in that case, and the stock kind of goes sideways. It seems like that moves out. We'd call that move a swing move. Okay, that's a shorter term trade. In this case, it took about a week. Maybe it takes a couple weeks, something like that. Maybe it just takes a couple days, but those are short term moves. I'm going to put ST for short term. Okay. Sometimes we do what are called trend trades. And this is what was the idea on this trade, is that it's a trend trade. So even though the stock has gone up and kind of went sideways, we're not looking to get out when it goes sideways on a trend trade, because as long as the trend is going up, we're going to stick with it. And when I say the trend going up, probably more of an intermediate trend is what we're looking at here. Is this trend still going up? I'd consider this trend still going up, right? We've been doing this, okay? The trend's been going up. We're above that 20-day moving average. So we're going to stick with that trend trade. But let's say this stock went down to 17 or something like that. It went down there. If the stock goes down there, would we still say that trend is going up? Probably not. At that point, we'd be breaking through we'd have lower lows. We'd be breaking our 20-day moving average, which I've kind of covered up with my line. So if the stock goes down here, we'd probably look to exit the trend trade. So we said there's swing trades, which are going to real short term. There's trend trades, which are a little bit more intermediate term. We're going to stay in as long as the trend there. And then there's what we call long-term trades. Long-term trades. And this is where leaps come in play. Because if I want to be in this stock and I think, hey, this stock is going to go up for the next year, and this isn't a recommendation on this stock, we'd have to look at it, but if I think this stock is going to go up for the next year, then rather than do an option that is going to expire in a month or in 3 months, maybe I want to do an option that's going to buy an option that is going to expire out a year or more. That's where leaps come in. All right. So that's kind of the basic background on leaps there. So what I want to do here before we actually get to examples, and I'm going to give you examples of both a call example and a put example, but I want to compare a leaps option to a stock. So we're going to say leaps versus stocks. Okay. And then I also want to compare a leaps versus shorter term options. Okay. So I want to kind of do both of those. So how does a leaps compare to a stock? Because, you always have choices when you're trading. Okay. You always have choices when you trade. One of the choices is what kind of trade, what kind of strategy are you going to use? Well, maybe you're thinking of buying a stock. Maybe you find a stock you like. Why would you do a leap? Well, one advantage maybe of a leap is they're less expensive than buying 100 shares of stock. In the case of Bank of America, that example we were looking at, the leaps option cost, I think, $700. Well, the stock, how much was the stock? Let me go back to BAC here for a sec. The stock we were looking at would cost for 100 shares of stock about $4,400. So definitely significantly cheaper there, okay? In that case. And of course, it just depends what strikes you pick. So less expensive is one thing for leaps. Now, one negative thing versus stocks is there is time decay. Time decay with leaps. That's that data. Do stocks have time decay? No. No. In fact, you know what? With stocks, you may get a dividend. With leaps, no dividends. Okay. So, and that may be more important to you or less important to you, but it is a clear distinction between buying a leaps option and just buying the stock. Is you're foregoing your dividend possibilities there. And here's another thing. Leaps, they expire. They may not expire for a year or 2 years out or something like that, but they do expire. Stocks don't expire, right? And finally, I mean, there's probably more, but something that I would mention as the difference is leaps are more leveraged. Okay, they're more leveraged. Now, is leverage good or bad? Well, the answer is yes and yes, or maybe the answer is no and no. Leverage is great if things go your way, but if they don't go your way, leverage stinks, right? It works against you. So that's if you're kind of debating leaps versus stocks, those are the things that kind of come to mind here for me as to some of the differences there. Well, what about leaps versus shorter term options? When would you do one versus when would you do the other? Well, number one is leaps are going to be more expensive. We already showed you that. You're buying more time, expensive. You're buying more time, they're going to cost more. Lower time decay. Okay, that rate of theta is going to be lower on those leaps. We do another one. That's versus shorter term options. They are options, right? And so both of them, neither of them, I guess I should say, pay dividends. Both of them expire. Of course, one of the differences is there's more time to expiry, okay, on those. Both of them can be leveraged, so you just got to double check that out, all right? So there you go. Now, Chris said something. Chris said lower delta. Yeah, this is going back to the stocks versus leaps thing, okay? Let's go back to that Bank of America example. And forgive me if I don't get the numbers exactly right. I think we said 100 shares of the stock would cost us about $4,400. Okay. The leaps was going to cost us about $700. It's cheaper. What's the delta on 100 shares of stock, though? The delta on 100 shares of stock is going to be 100. Okay. That's how that works. What was my delta on that? I don't know exactly. I'm not going to take the time to look right now, but it was probably about a 50 delta. Okay, somewhere in the 50 delta range. So if the stock goes up $1, then you'd be making about $100 on the stock. How much would you be making on the leaps? In this case, you'd be making about $50. You're only making half as much, but the investment, let's see, 6 times 7 is 42. The investment is a sixth as much. So you're getting half the movement for a sixth the cost. You see, when we talk about leverage, where the leverage component comes in on that is leverage on there. So it's not just the amount you make or lose. You got to also factor in the initial investment cost on that. All right. So good point here. Now I want to hit up some questions and then I want to give you an example on that. With leaps options, we're still going to look for liquid stocks just like we would for any other options trade there. Let me just see. I know Ben's been active in the chat helping me out. Let me just see. Are there any questions I've missed? Chris said, it seems to me with the lower delta compared to shorter term options, the price of the options will be less volatile. Options, yes, they will tend to be less volatile. That is correct on that, Chris. That goes to our point. Yes. So does it translate to lower IV? Well, I'll tell you what, let's take a look. We'll look at Bank of America here. Here's our average implied volatility, about 30% or so. As we go a little closer to expiration, well, roughly, we'll say about 30%. And so really, there's not a huge difference probably in implied volatilities. I would say you may see some implied volatility differences, but they're usually not enough that are going to make or break the trade, would be my take on that. Okay? All right, let's move forward here. So when we're doing leaps, if we're thinking of it from a leaps call standpoint, from a Leaps call standpoint, the one way to kind of mentally think about it is we're going to think about it kind of the same way we would buying a stock, because it's a longer term trade, like a stock. And Vic, you're correct. Vic in the chat said, IV does not impact stocks. Implied volatility changes do not impact stocks. That is absolutely true. Thank you for adding that in there. Okay. So what do you do when you're looking for a stock? Well, you may do technical analysis. You may look for a stock that's trending up. You may look for fundamental, you may look at support and resistance levels, stuff like that. You may look at fundamental analysis. Maybe you look at things like, what's its PE ratio? What's the valuation on that stock? Maybe you look is the company growing their earnings and sales? Those are all things that may come into play for your Leaps calls specifications there. So that's what we're going to do. And so, for example, what I was going to do is, let's start here. I'm going to pull up Caterpillar. And so if we're looking for a trend, you may look for something that's an upward trend. And this one I thought, well, hey, look, it looks like we're bouncing right off that 20-day moving average. Okay. Looks like we have a series of higher highs and higher lows on here. So there's our trend on that. We're above our 50-day move. This is a 50-day in blue, by the way, moving average. Okay. Now, what about fundamentals? What would you consider for fundamentals? If I'm doing a long-term trade, and of course, as always, buying the stock is a possibility here. But we're talking about this as a more leveraged possibility here too. So in other words, kind of going back to the stock versus Leaps question, if you're looking at a stock that you are willing to take a more aggressive stance on, i.e. more leverage, so you think it's going to be going up more, and you have you're not planning on holding on to 10 years maybe, maybe you're looking out for a year or two, and you're willing to take that more aggressive stance, maybe you consider a Leaps option as opposed to buying the stock, knowing what we said before, you're foregoing things like the dividend payment that could possibly occur there on that. Okay, so let's go and let's look at, what about fundamentals? What would people look on fundamentals? Well, a lot of time, I'll tell you this, a lot of people for fundamentals, and I'm not going to get into the details of this, but a lot of people for fundamentals like to look at things like analyst reports. Now, these aren't recommendations. These are third-party analyst reports. They get it wrong just like everybody gets it wrong at times. But sometimes people like the extra confirmation of third-party analyst reports, of looking and seeing what those analysts say about the company. And they look for more generally positive ratings over there. Okay, that's all I'm going to get into that. It's not a recommendation or anything on that. And analysts do get it wrong, but that is a starting point for a lot of investors on that. And so that may be a good sign for some investors if you care what analysts say when it is highly rated. Okay, but analysts are probably going to, if you're a longer term investor, you may look at other things like earnings per share. What do you typically want to see for earnings per share? This goes back 5 years, by the way. What you typically like to see is growth. Growth of those numbers. You want those numbers to be going up. And in the case of this example, those numbers are going up. Doesn't mean it can't fall apart. That trend can certainly change, but over the past, it has done well in that regard. You can do for a similar thing in terms of cash flow if you want. You can do a similar thing in terms of sales per share if you want. Look for those general trends to be going up in terms of earnings, sales, and cash flow. That is a fairly common approach from fundamental analysts there. Return on equity, is there some minimum return on equity you're looking for? Well, I don't know. Some people may look for a return on equity of 20% or more, something like that. Well, look, here's your return on equity. That's actually gone up pretty well too. So that's trending up. Most of these areas, including like margins, you like to see them going up. That's not every area though. net profit margin. You'd like to see it going up. However, some things like debt, you probably don't want to see it going up a lot. But if you're seeing a lot of growth, a lot of times you may see some increase in debt. But in this case, if you look at long-term debt to capital, it's held basically steady there. So that's probably a good sign when you're getting growth in those. And then other things, this isn't going to be a full class on this. I'm just kind of mentioning PE ratios, currently 16. You may have some notion of what you want in terms of PE ratio. In other words, fundamental analysis may take a part of your analysis for this. But if you are willing to want to take a more aggressive approach to a stock, maybe you do maybe you consider a LEAPS trade on this. Okay. Now, we have to pick options here in this case. Well, how long are you planning on being this? This is a longer term trade. I can go out a year. I can go out a couple years. Well, this is about a year and a half, I guess. Here's a couple years. This is going to be expensive. But Caterpillar is a $350 stock. How much would 100 shares of Caterpillar stock cost you? About $35,000 for 100 shares of Caterpillar stock. Even if we go up to, say, we'll go up to 67 delta here on this. I'm going to go in the money a little bit on this. It's going to be expensive option, okay? It's going to be about a $7,000 LEAPS contract. That's expensive, right? Well, it is expensive. Regardless of how you look at it, maybe that's expensive, but consider you're getting a 67 delta, 67% of the movement, or 2/3 of the movement of the stock for what percent of the cost? 7,000 versus 35,000? That's about a fifth of the cost there. There's the L word. That's your leverage in there. Now, maybe that's good, maybe that's bad, because if Caterpillar goes down, you're losing at a leveraged rate as well on that, okay? So we do want to see that. You want to make sure your bid-ask spreads make sense there. Probably, hopefully less than 5% of one another there, and certainly we have that in that case. Risk management, you can put in your risk. Maybe you don't want to risk more than 2% of your portfolio, of your active portfolio on these. Exit rules. What are your exit rules? Going back, you're going to probably treat it a little bit like a stock in the exit rules in terms of, as long as you're bullish on this, you're likely going to be willing to stick with it, even if it drops down a little bit. So if you're putting a stop, it's probably not going to be a real tight stop on that. Now, you can put a stop based on a contingent order based on the underlying stock price. And we could say, if we drop down below $320 or $300 or something like that, we're going to get out. Or you can do it based purely on the option price. Let's go to that option price. I'm going to go to that 67 delta. Often we'll go in the money on these, but you don't have to. I'm going to right click on this. I'm going to buy custom with a stop. Now, am I putting in a target price? You can put in a target price. You can put in a sell limit order, but I'm not going to. As long as this is going up, we're going to stick with it for our purposes here. Now, if I wanted to put this based on an exit based on the option, on the stock price, I could just change this from stop to market, make it good till canceled, click on my gear here, and I could say, if Caterpillar marks less than or equal to $300 or whatever area you choose, and save it there. Okay, that's actually not what I'm going to do here. I'm going to actually put a stop based on I'm going to put in a true stop based on the option price. We're looking to get in at about $70, and I'm going to put in a stop at about 70% of that. So 7 times 7 is 490. We're going to say right around $50 on our option is where I'm going to put that stop. That stop is going to be good till canceled. I already switched that. And I'm going to make this, to $50. Or maybe we'll go 49 just below that, 49.90, okay? So there we go. Doesn't matter. In the formula I kind of used in my head, though, just for those of you, if I just confused you on that, is I took a stop about 70% of my entry price. My entry price is about $70, okay? 70% of about $70 is about $49, $50 there, okay? So that's where I got that number for there. So there you go. Now, remember, just like a stock trade, well, look, you guys have all done this. Probably almost everybody listening to me has done this in some way. You bought a stock either in real life or in paper money or something like this, and you buy it and immediately, what does it do? It goes down or it goes sideways or something like that. Remember the long-term goal here, though. The long-term goal isn't a swing trade. It's not even a trend trade. In this case, this is a longer-term position based on technicals and fundamentals. And so we're willing to hold on to this for a little while here on this. That is the trade. I'm going to click on confirm and send, and I'm going to put that in my long single options. It's a long single option. It's just a leaps option. It's a long-term single option. And max profit, unlimited. The higher CAC goes up, the more money you make. Max loss, well, what about that stop, Brent? You said there was a stop in there to help protect you. Well, that's the goal of the stop, but it's not guaranteed. The Caterpillar could crater tomorrow, overnight or something like that. And the stock could go way down. And if the stock goes way down, this leaps call is going to go way down. Our risk on that is basically everything you put into that. Okay, that's true for a stock, by the way. If I bought 100 shares of Caterpillar, then I would be theoretically risking $35,000, even though Caterpillar going to zero is unlikely. And you're going to get more volatility in the option versus the stock price. So you got to be prepared for volatility. That's why this goes in your aggressive portfolio here. And there we go. We may be able to get a little better price than that natural price. So I'm going to move that down, see if we can save ourselves a few bucks on that. Long single options, we're going to send that. Okay. And it failed. Okay. There we go. That's an example of a leaps call. And there we go. All right. Let's go and let's talk about things from the other end of things. What about if you want to be bearish on this? I'm not going to get into shorting stock today, but that's one approach that people do when they want to go bearish on the market. What if you're bearish long-term on something? Could you do a leaps put? Yeah, you could do a leaps put. Let me pull up one here. Let me go to PFE. Here's Pfizer. Okay. Shorter term, our trend has been kind of downward, kind of near that resistance here on this. That's from the technical standpoint on this. This is what we've been doing, maybe bouncing, I don't know, we'll see. But clearly not bearish. Maybe there's not just a fundamental reason, or maybe there's more news reason. This is Pfizer. Maybe you think, well, is the U.S. going to, is the policy of the proposed idea of only paying drug prices in the U.S. versus what other countries pay, is that going to go through? Is that going to affect a company like Pfizer? Maybe it could. Maybe that's something that's part of your consideration. Maybe you do what we mentioned before. You go to the fundamentals here and perhaps you look at the third-party analysts. Again, not guaranteed, and you kind of look at their ratings there on that, and that's maybe a consideration. Or maybe you look at things like I mentioned before. You look at the earnings. What's happening with earnings? Well, earnings have actually not done so great the last couple of years there, right? Sales. What if sales? Well, sales haven't done that great in the last couple of years. Doesn't mean that's going to do that in the future. You can go on down the line. Your ROE is a lot lower than it used to be on that. So those are all considerations here from a fundamental standpoint. And, there's your PE ratio. if you're interested as well. Let's look at a Leaps put on this though. We're on Pfizer. I'm going to go out. It's a cheaper stock. It's only a $23 stock. So the options, therefore, are probably going to be cheaper. Now, you don't have to go out as long. I did 598 days, I think, on our last example. Well, let's go out just over a year. How about? Let's go out to June. How much would a Leaps put cost us? If we go at the money, 23, it's only going to cost us about $250. We could lose all of that. Let's go to our delta. I'm going to go in the money again. I'm going to go out to about 60 delta, 70 delta. We'll go split the middle. 65 delta. It's going to cost us a little bit under $500, it looks like, on this trade. This is a bearish trade. Where is our break even at expiration on this? Now, keep in mind, expiration is 387 days away. Well, for a Leaps, well, it doesn't matter, any put option, your break even at expiration is you take the strike price. In this case, it's 27. You subtract the premium, which I'm going to say is $5, okay? Close enough. And here we come up with a break even around $22. Now, that's certainly below where we're at right now, but not ridiculously far below where we're at right now. That's less than 10% below where we're at right now, and we still have 387 days for that to work out. That's break even at expiration. If the stock drops down to, say, $22 in the next month or two, I would expect this to be a rather profitable trade at that point, but you just never know. Okay, so there we go. The other rules are going to be the same in the sense that we want liquidity on those contracts. Okay, we're going to exit if we're no longer bearish. This is a longer term trade. I'm going to right click on this. I'm going to buy custom. I'm going to put in a stop order. There we go. I'm going to use that same stop. I'm going to go 70% times 5 is going to give me about a 350 stop. Stop. Good till canceled. I'm going to make this a 350 stop here. And I'm going to confirm and send. This is just one contract. How much am I risking? Well, I'm risking $495. Max profit, 2,200. That would be if the stock goes to zero. Unlikely to go to zero, but that kind of shows you that's a reminder, I think, to look beyond when you look at trades, max profits or max losses for that matter. That's a consideration, especially in the case of a max loss, but also consider your zone of a more likely scenario. In other words, the likely scenario isn't this goes down to zero, but is it certainly reasonable to think it could go down to 18 or 19? Yeah. What's your profit going to be in that circumstance? Or in the case of Caterpillar, which we were looking at earlier, is Caterpillar likely to go down to zero? Probably not. But what are you going to be losing if the stock goes down 10% or 20%? Consider those scenarios. So it's not just max gain, max loss. Think of it as a max or a likely gain and a likely loss scenario there. And just be humble enough to realize, hey, look, we all get it wrong sometimes. And that's why we position size on this. And you don't have to position size necessarily to the max loss. Our position size here, in this case, we could say, well, we're really risking about $150 on this contract. And if I don't want that to be more than 2% of my active trading portfolio, fair enough. You can do your math from that. Okay? All right. And I'm going to send this order, confirm and send. I'm going to put this in my long single options category. I'm going to send that order, and there we go. We just filled that, okay? So there's a couple trades on there. Now, I'm going to need to get going here, but let me just mention something. Tomorrow I have a managing options portfolio webcast, and I'm planning on adding a stop in on that XP trade. We have a long call on that. No stop is on that right now, so we'll probably look to add a stop to that. And also on our PayPal trade, which we have a long call, let's re-examine the stop there and make sure that's an appropriate area, because sometimes we'll move that stop up. We're up $180 in this paper money example trade on that. But when things are going well, you may want to re-examine those stop losses. We'll do that in our managing options portfolio class tomorrow. Okay. Hey, Ben, thank you for helping me on the chat as always. And I want to thank each of you. Oh, by the way, let me just mention this. Ben teaches a futures class on Tuesday mornings. Tuesday mornings, 9:30 Eastern time. It's our Trader Talks futures version of that. Great class. I was there this morning for it. Good stuff. So anyway, everybody, thanks for joining me today. Have a wonderful week. Coming up next, we have Getting Started with Technical Analysis. And we'll see y'all at the same time next week. Bye-bye, everybody.